Nvidia just got what Wall Street wanted. The United States cleared some Chinese companies to buy Nvidia's H200 AI chips. That should have been a clean win. But then came the strange part. The US said yes. China still has not. According to Reuters, not a single H200 had been delivered to those approved Chinese buyers. That one detail tells you a lot about Nvidia in 2026. This is no longer just a chip company. This is no longer just an AI demand story. Nvidia is becoming a China policy stock. Its share price does not only move on GPU demand, cloud spending, or data center orders. It also moves on export licenses, presidential summits, Beijing's industrial strategy, and whether China wants to buy American chips at all. The biggest risk to Nvidia may not be demand, it may be permission. In mid-May 2026, Reuters reported that the US had cleared around 10 Chinese firms to buy Nvidia's H200 chip. The H200 is not Nvidia's newest Blackwell chip, but it is still one of the most powerful AI chips Chinese companies could legally hope to access under current restrictions. For Wall Street, this looked like a breakthrough. Nvidia had spent years dealing with export controls, and China had gone from being a major growth market to a political minefield. So any sign that H200 sales could reopen was immediately treated as good news. Nvidia shares jumped, the broader AI trade got another burst of confidence, and the story seemed simple. America is letting Nvidia sell, China's AI companies can buy, Nvidia gets revenue, and investors get another reason to stay bullish. But the simple version is not the real version. The most important line in the Reuters report was not that the US cleared the sales, it was that no deliveries had been made. That means permission from Washington was only one side of the transaction. The other side sits in Beijing. Chinese companies may want the chips, Nvidia may want to sell the chips, American officials may be willing to allow some sales. But China still has to decide whether this is politically acceptable, strategically useful, or too risky. Nvidia did not just need a customer. It needed two governments to tolerate the same transaction at the same time. That is a very different business model from simply shipping chips to a cloud company. And it is why Nvidia is starting to trade more like a geopolitical asset. Then came the image that made the story feel almost cinematic. Jensen Huang, Nvidia's CEO, joined President Trump's trip to China at the last minute. According to Reuters, Huang told Chinese state broadcaster CCTV that he hoped the US and China would improve two-way ties. That is not just a CEO doing public relations. That is the head of the world's most important AI chip company trying to keep access to the world's second largest economy. For Nvidia, China is not just another country on a sales map. China is a massive pool of AI developers, cloud providers, internet platforms, and national technology ambitions. But it is also the place where every sale can become a national security question. So Huang's job has changed. He is not only selling chips, he is navigating the border between commerce and state power. Now here's the counterintuitive part. China needs advanced AI chips. Chinese technology companies want more compute. AI models need GPUs. Data centers need accelerators. And Nvidia's ecosystem is still extremely hard to replace. So why would China hesitate? Because buying Nvidia chips is not just a purchase, it is a signal. If Chinese firms rush to buy H200 cents the moment Washington opens the door, that confirms something uncomfortable. China's AI industry still depends on American hardware. That is not the message Beijing wants to send. China has spent years trying to build domestic alternatives, strengthen its semiconductor supply chain, and reduce reliance on US technology. So even when Chinese companies want Nvidia chips, the government may prefer a slower, more controlled process. Beijing can use delay as policy. It can tell domestic chip makers that the door is still open for them. It can remind Washington that US approval alone is not enough. And it can avoid looking like it is begging for American technology. China may want the chips, but it may not want to look like it needs the chips. For investors, the question is not just whether Nvidia can sell a few more chips this quarter. The question is how to value a company whose biggest upside markets are increasingly controlled by politics. In the old Nvidia story, the main variables were simple: GPU demand, margins, cloud capex, data center orders, and the next generation product cycle. Those questions still matter, but now there is another layer. US approval, Chinese permission, export rules, domestic substitutes, and political backlash. That layer creates a policy discount. Even if demand is real, investors have to ask whether Nvidia can actually access all of that demand. And if access depends on politics, the valuation becomes more fragile. Export controls were designed to slow China's access to advanced AI capabilities, but they created a complicated trap for Nvidia. If the US blocks too much, Nvidia loses sales, and China has a stronger reason to build replacements. If the US allows too much, lawmakers may argue that national security is being weakened. Nvidia benefits from globalization, but its most important product now sits inside a strategic rivalry. The company can make the best chip in the world, but the best chip in the world still needs a license, a buyer, a shipping path, and political approval. That is not a normal product cycle. That is a policy cycle. This is why Nvidia's stock can rally on a headline and then wobble on the next clarification. H200 approval creates upside. No deliveries create uncertainty. Jensen Huang joining a presidential trip creates hope. US. Officials saying chip export controls were not a major topic of the meeting removes some of that hope. None of this means Nvidia is weak. Nvidia is still one of the most important companies in the world. Its chips remain central to the AI build-out, its software ecosystem is a massive advantage, and cloud companies still need compute. But a real demand story can still be repriced. The risk is not that customers do not want the product. The risk is that customers cannot freely buy the product. The risk is that governments turn the product into leverage. The risk is that the market values a political breakthrough before the breakthrough actually happens. The bigger lesson is that AI investing is becoming geopolitical. Compute is not just a business expense. Compute is power. The country that controls advanced chips controls part of the AI supply chain, and the companies that control the chips become strategic assets. Strategic assets do not live in a purely free market. They live in a world of restrictions, negotiations, national champions, security reviews, and industrial policy. That is the world Nvidia now lives in. From here, investors should watch actual H200 deliveries, not just approvals or rumors. They should watch Chinese official language, domestic Chinese chip momentum, US, political backlash, and Nvidia's own guidance. Nvidia's China story is not simple anymore. The US can say yes. China can still wait. Companies can want the chips. Governments can slow the transaction. Investors can price in a breakthrough. But the shipment still has to happen. That is the new Nvidia. Still powerful, still central to AI, still one of the most important companies in the market, but no longer priced only by technology, priced by policy. When a company's biggest product depends on presidential meetings, export licenses, and Beijing's industrial strategy, it is no longer just a semiconductor stock. It is a China policy stock. And the biggest risk may not be demand. It may be permission.